Hey everybody, it's your boy Leif van Onselen, the young conventional economist, chief economist at macrobusiness.com.au and the MB Fund, coming at you again with another macro breakdown, where today I want to talk about interest rates, in particular the Reserve Bank of Australia's Statement of Monetary Policy that was released on Tuesday. Now the RBA statement is important because it signalled that interest rates are going to rise soon. In its February monetary policy statement, the RBA said, and I quote, "The board is prepared to be patient as it monitors how the various factors affecting inflation in Australia will evolve." However, in the March monetary policy statement, the Reserve Bank of Australia replaced the term patient with the statement that over coming months, important additional evidence will be available to the board on both inflation and the evolution of labour costs. The board will assess this and other incoming information as it sets its policy. Now, to me, that reads like the Reserve Bank of Australia is losing patience, and the record low interest rate of 0.1% that Australia has experienced over the pandemic will soon come to an end, with the RBA likely to lift the cash rate if upcoming consumer price index and wage growth data comes in hot. Now, given Australia's unemployment rate is currently 4%, the lowest level since 2008, and we are experiencing record tightness in the labour market, it's very likely that Australian wage growth will soon pick up above the RBA's stated target of 3% annual wage growth. If and when this happens, the Reserve Bank of Australia will pull the lever on interest rate hikes. With interest rate hikes all but assured, the question now is how high will Australian interest rates go? The futures market, would you believe, has actually upgraded its interest rate forecast for Australia. The markets are now tipping that the Australian cash rate is going to rise by 3.25% by August 2023. That's shown in the above chart by the yellow line. If this happened, it would be the equivalent to 13.25% rate hikes in only 16 months. Several of Australia's banks are far more realistic, however. The Commonwealth Bank of Australia tips that Australia's cash rate will peak at 1.25%, whereas Westpac tips the cash rate will peak at 1.75%. But if the market is correct, and the cash rate does rise by 3.25%, mortgage repayments would rise by 42%, assuming the cash rate is passed in full to mortgage holders. This would see monthly mortgage repayments on the median price Australian home rise by a whopping $1,200. Monthly mortgage repayments on the median price Sydney home would rise even sharper, by $1,800, whereas monthly repayments on the median price Melbourne home would rise by around $1,300. Whatever the case, Australian mortgage holders would be hit with massive increases in mortgage repayments if interest rates do rise, as predicted by the markets, by 3.25%. This would place Australian mortgage holders under extreme financial pressure and would very likely crash the Australian housing market and could potentially lead to an Australian recession. The bottom line is that interest rates are sure to rise, most likely in the third quarter. But the Reserve Bank of Australia won't hike rates as aggressively as the markets are tipping, because doing so would crash the housing market and would crash the Australian economy. For what it's worth, I'm tipping a 1% rise in rates, which would still lift average mortgage repayments by 13% or $343 a month on the median priced Australian home. We've got to also remember that most of Australia's inflationary pressures currently are imported via petrol prices, so lifting interest rates won't alleviate the source of Australia's inflation problem. Anyway, that's all from me today. I hope you enjoyed the video. Please leave a like and subscribe, and I'll see you in the next one. Thanks for watching.